Hello. So in today's video, we're going to have a look at Peloton, and I'll show you how as an investor, I would try and stay up to date with the situation. So just to give you some context, I was originally a couple of days ago reading this article by one of the analysts at Simply Wall Street, and it was basically saying that the company can't be sold until insiders actually agree. And this is basically given the current structure of the shares and like the voting rights that these shares hold. And so this article was going into that. It talked about how like activists being Blackwell's Capital stood in and like we're urging significant changes to the company. It talks about how Barry McCarthy's now replaced Jim Foley, and how Barry McCarthy is actually, if you're not familiar with him, he used to be the CFO at Netflix and Spotify. So he has a lot of experience with like software subscription businesses, and that's quite interesting, right? Because that kind of experience could help Peloton, and we'll get into that in just a second. The article also went on to like who could actually acquire Peloton, and it was covering the likes of Amazon and Facebook and Nike and Apple, and just saying how like given their businesses, how could they acquire Peloton, and how could like it provide some sort of logical cohesion if they were to join. So having read through this article really provides some context about if the company was to get acquired and if insiders were to agree on, like, say one of these companies like provided or came out that they want to take over the company, the insiders could actually vote in favor of it. And the article finishes off here saying how like company insiders still hold like 60% of the voting rights due to the voting structure. So even if Barry McCarthy doesn't want to sell the business, because I'll get into that in a second why he doesn't want to, the insiders could still vote and say yes, they do want to sell the business. So Barry McCarthy's come in, and basically he wants to revamp the company and to kind of like improve on what its strengths are and cut down on its weaknesses, and like just cut ties to its weak part of the businesses. So this article was enlightening to go, okay, he's got the intention of revamping the company, but they could still sell underneath him if they thought the offer was so good. So I was also having a look at one of these recent newsletters written by Ben Thompson from Stratechery, and basically it explains how Peloton's income statement kind of looks, right? And so just to give you a glimpse of it here, it shows how the company's cost of revenue has actually been increasing quite a bit, right? And so as a company's cost of revenue, as a percentage of its revenue increases, that's really not good, right? Because that impacts its gross margins. And so back at the start of 2020, it used to be around 60% here, cost of revenue, but it's now actually closer to like 75%. And that's really not ideal, right? And he explains here in his newsletter the main reason, or this change is thanks in large part to the company actually cutting the prices on its hardware products. And I think it's down to like $1,500 for a bike now, and it used to be more expensive. And he also talks about the changes in the other company's expenses like research and development, general and admin, sales and marketing. And so this sort of breakdown here really doesn't look that appealing. You'd like to see a company like achieving scale and having its top line revenue growth, and the percentage of these other expenses actually decreasing as a portion of revenue, but it really doesn't seem to be the case with Peloton, and that's why it's in a bit of a sticky situation. And so having had a look at that newsletter, which I highly recommend, it's very insightful, I then had a look at the company's report on Simply Wall Street. And so I just wanted to show you how I would try and stay up to date with the business and its developments on the platform. So I'd have a look at Peloton and scroll down basically through the company overview section to the news and like recent news and updates. So having a first look here, I would check out the price history and performance. And this here, if you're not familiar, is just basically obviously the stock price chart, but also it gives us some developments in the underlying business, right? So any dividends being paid, financial updates, management updates, strategy updates, or anything else. And so you can see it's been a busy couple of months here with these updates here that have occurred over the last 6 months or so. And so what I would have to do is have a look at the developments and just try and stay up to date with the business and see what's going on. So this very first one here, Peloton dismisses sale talk. So straight away that tells me, okay, they're not interested. And as we mentioned before, the new CEO, Barry McCarthy, seems to not actually have any intention to put the company up for sale, right? He actually wants to pursue growth by doubling down on content, expanding to new countries, and increasing its product portfolio. And he said, if I thought it was likely that the business was going to be acquired in the foreseeable future, I can't imagine it would be a rational act to move across the country, he said. Therefore, there are lots of other things I could be doing with my time that are quite lucrative than hanging out with a business that's about to be sold. Okay, so that tells us that like he took the opportunity and basically plans to stick with it, right? He didn't want to just prep it for a sale. If this is true, he moved across the country, so that in itself tells you like he packed up and moved, and that's kind of like tells you it's a long-term decision. It also talked about how, like, yes, there is still the right for insiders to obviously sell the stock, given to vote in favor of selling the company, given the voting structure. But he's believed that shareholders would be confident to vote in favor of his leadership of the business, which is why he agreed to take the role in the first place. So he wants to expand the digital community and enhance content, and he says or believes that could make it a very fast-growing business with very high margins. His playbook would include developing product line extensions so customers could own multiple machines. He added, however, that an entirely different pricing structure could replace a $39 subscription fee, a monthly subscription fee. And so that's kind of interesting, right? Like, given he has experience as the chief financial officer for Spotify and Netflix, and he knows subscription businesses very well, it kind of makes sense that he would kind of have that leaning towards wanting to be changing the company's reliance or main business to software businesses, right? Because the part of its business that is subscription based, because those are obviously very high margins. And Ben Thompson also goes into that here. Have a look at the subscription business here. It talks about gross margins being like 60 odd, maybe close to 70%. And the numbers there are much more appealing, right? And that's its software business. Its hardware business is where it actually has to make the bikes, and that obviously, as we saw up here, it's having quite a big negative impact, because obviously it can't sell the software without selling the hardware, but it doesn't actually necessarily need to do that hardware in-house, right? Like this article here from Ben says there's actually plenty of companies out there that do produce bikes, and they could sort of team up with an external provider to actually do all the research and development on the bikes, to build the bikes and spend and have that sort of part of the business externally, so that it actually improves the Peloton's structure of how it makes money. So that's kind of an interesting take, right? Like, as I read through this, if I had a thesis on Peloton beforehand, I might look at it now and be like, okay, Barry McCarthy wants to come in, wants to change the focus of the business to like the more higher profit margin or higher gross margin businesses, being the software side of things and the subscription side of things. Do I think that's likely to occur? And so I would have a look at Barry McCarthy's history, see how he did when he was at those businesses, Spotify and Netflix, and also just see what I think the likelihood of it is to occur. And that can be helped by reading through these updates, right? And so the next section I'd have a look at is just the recent news and updates. As we saw, Peloton actually dismisses the sale talk, so it doesn't intend on being sold. Of course, insiders can still vote in favor of that, but he actually intends on fully revamping the business and improving it. And so the next update is actually analysts don't seem too optimistic, right? So recent news came out of their guidance, and consensus revenue estimates from analysts have fallen by 12%. So this tells me that, like, okay, the next year or two could be quite a expensive / non-performing year, where the business is actually expected to grow its sales a bit, but it's like not as well as they were before, right? So the revenue forecasts have decreased from 4.2 billion to 3.7, quite a significant decrease. Forecast losses are expected to increase from $3 to $3.95, quite a lot. Meanwhile, the leisure industry in the US is actually expected to see its net income grow by like 13% per year. So it's obviously expected to underperform the industry. And lastly, the consensus price target was down from $47 to $44. So as analysts kind of revise their estimates, they're obviously decreasing their price targets for the stock, because they don't think it's going to be trading as highly in the next 12 months. And lastly, here, share price rose 10% to $32.83 over the past week. And so when this update came out a few days ago, the share price rose considerably when there was rumors of a company potentially acquiring the business. So that was basically just investors being like optimistic of, oh, yep, we're going to get bought out. But as the CEO has said, he doesn't plan on that being the case. But as I mentioned, insiders can still vote in favor of it if they get provided with an offer. So to get more update on it, I would just read through these updates here. Again, we saw that no plan to sell, and there's articles here from Seeking Alpha as well, basically just saying like, okay, there's some people believe it's worth even less now, and suggest people get out of the stock. So it's a very volatile time for the business, right? Like, it's going through a huge transition, new leadership who plans on completely revamping the business, and that obviously is like a unpredictable situation, right? So as an investor myself, I need to look at this and be like, okay, what is I think the likelihood of this business actually improving, given the changes they want to implement? What's the likelihood of them actually happening, and versus what's the likelihood of the business actually just crumbling, in the potential of like just continuing to see more negative news coming out of the underlying business, and the new leadership potentially struggling to like implement what they want to. So I need to look at that, and then also what's the likelihood of another company like Amazon or Apple or whoever coming along and saying, "Yep, we do want to buy you," and then provide this offer to your shareholders, and then shareholders saying yes to it. So I need to kind of think of those different aspects. And one of the last things I want to cover is this here. So here's the earnings and revenue breakdown, and as you can see, the cost of revenue is actually quite high, right? This is $2.9 billion, and that's to generate the $4.14 billion of revenue. And the estimates for revenue next year are actually lower. As we saw, it's now like 3.7 odd billion for the future, for the next 12 months, I think. Yeah, so we saw it's actually expected to be lower. But what's interesting here, right, is that this structure here will actually change if Barry McCarthy is able to implement what he's planning on implementing, right? So should he change to the more higher margin software subscription business and like reduce the reliance on the hardware side of things, or in fact even outsource that completely, this structure here could completely change, right? So its gross margins could improve from 30% to much higher. Like we saw, the software business has like almost 70% gross margins. So this could really change the business. So it's currently gross margins like 30%. But in 12 months' time, if all this news was to come out, this could be a very different summary here. So this is kind of what I would keep an eye on. And so, yeah, just as a summary, I would continue keeping an eye on the recent news and updates up there. I'd keep looking at the price history and performance because updates come through there. And I've actually added the stock to my watch list here. I just unclicked it. And so now that it's in my watch list, I'm going to receive updates on the business. So any important updates will be sent to my dashboard and to my inbox. And this will just help me keep my finger on the pulse of the company and see what the developments occurring. And basically, this will help build my narrative, because obviously it's a very volatile time, it's a very transitory sort of period, but it could be an interesting opportunity because if he can implement what he plans on implementing, the business could look very different in 12 to 24 months time. So yeah, I hope this video has been helpful just to give you an idea of how I would kind of like monitor the stock and see what occurs in the underlying developments. So yeah, I hope this video has been helpful, and thank you so much for watching.